When Warren Buffett was just 25 years old, he started his first investing firm, Buffett Partnership. This investing firm existed from 1957 to 1969, and during its time, Buffett achieved an average return of 29.5%. The interesting thing about the way Warren Buffett invests is that he uses very simple methods when it comes to investing to achieve these high returns. So the key to achieving high returns is being rational and following simple strategies, and sticking to them when times get tough. Now in this video today, we'll be revealing to you the rules Buffett used to achieve such a high return. But I'm not saying you're going to achieve a return as high as Buffett's. I mean, he has dedicated his life to investing and he's a very wise man. Nevertheless, if you can follow these investing rules from Warren Buffett, it will drastically help your overall long-term return. If the business does well, the stock follows. If you've got a diversified portfolio, if you're just buying some index funds and you've got a long enough time horizon, it might be best just to ride these roller coasters. Warren Buffett learned this rule when he first picked up one of the greatest investing books of all time, The Intelligent Investor by Benjamin Graham, who later became Buffett's mentor. One of the rules taught in the book was very simple. The rule convinced Buffett that when you own a stock, you own a piece of the business, and over the long term, if that business does well, the stock will also do well. Investors who sell when the markets are down may end up derailing their long-term plans. So look for the companies that are going to dominate in the future, that make a high profit margin, that are already ahead of the competition, and one their consumers love. You don't need to complicate it. Stocks are a part of the business, and if their business does well, you will do well. Most news is noise, not news. Markets don't settle down, they settle up. By the time the news looks a little bit better, the market has already recovered. And if you miss the recovery, there's a very, very good chance you're going to make it harder to hit your financial goals. Instead, most investors want to ignore their 401k accounts instead of checking them every day. This is probably his least popular opinion, but Buffett thinks most news we consume about investing is not useful when buying a financial asset. In the era of the internet, finance programs, newspapers, and even YouTubers all have a personal interest in getting you to listen to them. Even without using clickbait, they tend to create as much hype and tension as possible to attract your clicks and views. But to invest long-term, you only need to pay attention to a small part of those. Owners of stocks too often let the capricious and irrational behavior of their fellow owners cause them to behave irrationally as well. Because there is so much chatter about markets, the economy, interest rates, etc., some investors believe it is important to listen to pundits, and even worse, to consider acting upon those comments. Not everyone is trustworthy. What I said earlier isn't to say you shouldn't listen to anyone at all. Even Buffett has had several mentors throughout his career. First it was Benjamin Graham, and then it was Charlie Munger. And now we common investors can use the internet to see the exact moves of many great investors such as Buffett himself in real time. For a lot of people, not looking at this might be the best way to kind of help them sleep at night. The key word here is trust though. Should you trust a random YouTuber that just wants you to click on his affiliate link? Probably not. Only listen to those you know and trust. Picking the right investment is about your needs, not what others think will do good. Plan on holding forever. In the past 20 years, investing in low-cost index funds like the S&P 500 has come to dominate much of the investing landscape. The reason? It's cheaper than investing in most mutual funds. There's far less trading, which increases costs and the primary structure that is used to invest in index funds. Exchange-traded funds or ETFs also have tax advantages. No one can pinpoint the exact date when it became clear that investing in index funds had won out over investing in active management, but Warren Buffett declaring it to be so was certainly a pivotal moment. You've probably heard of this, but compound interest is pretty powerful. Whenever you earn a dividend or register a capital gain, reinvesting that money makes you even more money. But if you keep on buying and selling stocks, you're probably not letting compound interest do its thing and missing out on a lot of long-term returns. That's why the important thing is time in the markets and not timing the markets. It's why you should be prepared to hold on to the same stock forever. If you do your job correctly when you purchase, the time to sell is rarely. No intrinsic value. In his 2017 letter to shareholders, Buffett took note of the high fees of hedge fund managers and offered what he called a simple equation. If Group A, active investors, and Group B, do-nothing investors, comprise the total investing universe and B is destined to achieve average results before cost, so too must A. Whichever group has the lower cost will win. And by doing your job correctly, this is what Buffett means. If you do not follow this particular rule when investing, all of the others are pretty much worthless. No matter how good the company, no matter how good its managers are, you have to understand that it's not worth an infinite price. You have to make sure it's below its intrinsic value. Nobody doubts what a great car a Ferrari is, but that's not what you're dubious about when you consider buying it. You have to decide whether it is worth the $250,000 it costs. The same could be said about stocks, which is why Buffett himself says, "No company, no matter how wonderful, is worth an infinite price. Price is what you pay, but the value is what you get. And to value, know how to calculate intrinsic value." His advice to investors: when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outside profits, not the clients. Both large and small investors should stick with low-cost index funds. Understand what you're buying. This is very simple, but also fundamental. Know the company you're buying from. Perhaps one of the only patterns across Buffett's portfolio is the fact that the businesses he invests in are very simple. Coca-Cola sells soft drinks, Apple sells iPhones and iPads, Southwest is an airline, and the furniture market seems pretty self-explanatory too. Buffett was saying something that had been known to savvy investors and traders for almost a century, but had taken a long time to seep into the average investor's consciousness. Active fund managers have a terrible track record. Standard & Poor's have been tracking the record of active managers for more than 20 years. Their mid-year 2022 report indicates that when adjusted for fees and for funds dropping out due to poor performance, after 5 years, 84% of large-cap actively managed fund managers underperformed their benchmark, and after 10 years, 90% underperform. That is so bad that Standard & Poor's is a 2019 survey of the results said the performance of active managers was worse than would be expected from luck. Risk only comes from not knowing what you're doing. Be fair when others are greedy. This rule would have been great to know if you started investing in January, as it comes in handy during very long bull markets. When the markets keep going up, with stocks like Apple which double their value in 24 months, everyone gets greedy. During times like these, people tend to get overconfident in their investing skills and put even more money into the market, making it harder and harder to find a good deal. These are the times in which you have to be more cautious, which is exactly what Buffett did. Last year, by stacking $128 billion in cash, worth almost half as much as his whole portfolio. But if there's one thing we could be sure about, the moment panic starts to set in inside the stock market, he'll be snapping up a lot of stocks when they're on sale. And we're coming to the end of this video today. If you enjoy this video and you find it helpful, give it a thumbs up and don't forget to subscribe.